This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find a download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means that you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Victor's picture saying, looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA printed a drawdown of 846,000 barrels. That was against expectations of a 3 million barrel drawdown, so a much smaller draw than expected. Cushing, Oklahoma printed a drawdown of 486,000 barrels, and inventory levels at Cushing are really starting to get critical. Now, I should have been a little bit more careful in my language last week when I repeated what people on Twitter were saying about tank bottoms. Now, it's not actually tank bottoms. There's a minimum operating level at Cushing, which is needed in order to support their blending operations and the other things that they do there. So it's not technically tank bottoms. It's virtual tank bottoms, if you will. We're down to that minimal operational level, and fears are growing. That means that we're seeing a resurgence of backwardation in the term structure of WTI. Gasoline drawing down 2.2 million barrels, distillates building 275,000 barrels for a net petroleum drawdown of 2.8 million barrels. U.S. production ticked back down 100,000 barrels to 13.3 million barrels. That's the plateau level that held for quite a few months. We've seen just a couple of weeks where we poked our head up to 13.4. See if we can get to 13.5. As I mentioned in the feature interview, the rub is that on one hand, some analysts expect OPEC Plus might terminate production cuts. That would allow more oil production, and that's definitely bearish prices. The other side of the coin, of course, is that intensifying geopolitical tensions are adding to the geopolitical premium, which is bullish prices. I'm flat crude right now and focused on other markets. For those of you who want to follow this more closely, our good friend Dr. Anas Al-Haji has had some excellent commentary and coverage in recent Substack and Twitter spaces. So I would direct you there for more detailed coverage, particularly around the significance of whether or not OPEC is really about to increase production and how that relates to market expectations and perceptions.
Yeah, Eric, the prevailing trade range on crude oil is still the most dominant. I have page 2, I have that chart of crude. And what you can observe is that over the last 2 years, we've been in an incredibly sideways tight trade range. And neither the bulls nor the bears have been able to prevail as we bounce around like a ping pong through to these different support and resistance levels. At this moment, we are much closer to the bottom end of this range. And I think that it's a fair assumption that there's a floor on oil that should hold somewhere in the $68 to $70 area, but that's pretty much all the bulls can hang on, is that the downside at this stage is going to be likely contained, and at some point there will be a trade back to the top end of those ranges that emerges. But right now, at least in the tail end of the summer, there seems to be no life in oil just yet. Now, moving on, I want to get Nick involved in the conversation. And Nick, listen, let's talk about that S&P 500. What levels are you watching here?
So right now, spot price on SPX is approximately 55.90, and we have an implied move for the September 20th monthly OPEX of plus minus 140 points. Therefore, the upper implied move is 57.30, which would mark new all-time highs, and the lower implied move is 54.50. Right now, we have key resistance at all-time highs of 56.70 and key support at 5500. I'm inclined to think we see some more chop into that September monthly OPEX, followed by a window of weakness or so. With NVIDIA reporting last night, having strong results, but falling, that tells me that perhaps the top is in the short term.
Yeah, it's interesting you say that. First of all, those that were looking for big volatility, either to the upside or downside on NVIDIA, were sadly disappointed. And it really now puts in play that the next major market move is likely to hinge off of the September jobs number and then going into the first FOMC rate cuts. And so with the market here pinned and not making a big move on this earnings, it's likely that at least until Labor Day where things will be quiet. And then the first few days going into that jobs number number is going to be where all the market setups are going to be. Definitely the idea that the S&P's top is in is something that I've entertained all along. A double top retest was always in play, but really I think it's going to be the post FOMC period, like you suggested. It's going to really define whether or not the market is in a bigger topping formation or whether the bulls will prevail one more time into the elections. With that said, Nick, with your view that way, what option strategy are you currently using?
So right now, for hedging purposes against my longer portfolio, I'm using butterfly put spreads, 20 points wide approximately, out of the money, where you have incredible asymmetry of risk. Like, for example, you can risk $1.80 or so to make a maximum profit of $18.20. Which is incredible because it's about 1,000% return on the upside. Now, granted, you rarely ever hit that middle point, but if, for example, we see a decline of 2 to 3% in broad markets, and you watch your position go from $1.80 to, for example, $6 or $7, that hedges you out a few percent on your portfolio decline, which is kind of nice, and it costs you very, very little. One other strategy I use pretty often, especially when I'm being more cautious in terms of when it was a weakness in the markets based on seasonality, like the last weeks of September, for example, is I use deep in the money options, usually leaps, so a year forward in the future, to express my overall bullish thesis while having a much, much lower overall exposure to risk. It's kind of a nice strategy to use. And I noticed that you actually posted a video on your YouTube channel discussing this.
Yeah, Nick, I decided to put in a YouTube video discussing the option strategies that Nancy Pelosi uses on numerous occasions to leverage her returns. Now, most traders use long gamma option strategies for convexity and to construct fixed payoff profiles. But she is using the options as an alternative method to margining to control margin risks while creating definable downside risk.
Yeah, it's a very straightforward strategy, and it's interesting how it manages so many different risks that leverage investors and traders are exposed to, and it's kind of surprising that not many of them use it.
Yeah, absolutely. So listeners that want to better understand the strategy Nancy Pelosi uses, just check it out on my YouTube channel, Patrick_Ceresna. You'll also find the link in that Research Roundup email. Now, Nick, let's move on to the Nasdaq, particularly the QQQs. What are the levels now, especially in the post-NVIDIA numbers?
Right now, we have a spot price of approximately 472 on the Qs, and we have an implied move of plus minus 20 points for that September monthly OPEX. Therefore, we have an upper implied move of 492 and a lower implied move of 452. Right now, we have key resistance at all-time highs of 504 and key support just below at 465. As I mentioned prior, NVIDIA had a pretty damn good earning report. However, the stock price has not responded well at all. It's down a few points right now, but that's more of a function, I think, of the high level of options activity on the stock itself. And I think it'll probably pin around this price and then have a move next week after the options expire. I am currently bearish on tech right now overall, and I am using those butterfly put spreads I mentioned previously to hedge myself as well. However, I am bullish on certain names like Palantir, Shopify, AMD, and NVIDIA.
Well, Nick, moving on to page 5 with the volatility index, and it's interesting that the VIX stays at an elevated level. I mean, we spent the entire first half of the year more or less trading at the 15 level and less on the VIX, and here we are going pretty much on a sustained month of trading at the 15 plus handle on the upside of volatility. Yet the market seems pretty calm here on the very short term, but clearly there are some different trigger points in the coming month, whether it's the jobs numbers or the first FOMC rate cut, that could be, triggers for future volatility in the marketplace. Well, how do you size up the VIX here?
So with the VIX at a 16 handle or so, we can expect to see top to bottom intraday ranges on SPX of approximately 1%. And it's interesting because we're seeing this elevated level of the VIX even as the markets go higher. And I think that's attributed largely to two things. One of them is seasonality and a decline in the latter half of September. And the second one is that we have the election coming up in a few months, and that is going to cause a lot of percolation and volatility as uncertainty rises as to who will win the election ultimately. Overall, insurance is not as cheap as it was a few weeks ago, but it is still somewhat cheap if you are hedging S&P 500 correlated portfolios. But it's important to understand that if you're playing a long game, it doesn't really matter. In the grand scheme of things, markets will move, and ultimately quality companies will go to the upside. And moving on to page 6, we have that US dollar index, which is in a decline right now, but perhaps bouncing off a bottom. What are your thoughts here, guys?
The dollar sell-off trend that Louis Vincent Gav predicted here on MacroVoices a few weeks ago is clearly in play, but markets never move in a straight line, and this market feels overdue for at least a dead cat bounce. I doubt it's going to change the primary trend, which is clearly down, but I think a bounce is likely, and it appears that one may have already begun.
Well, a bounce or no bounce, the one thing that is still very dominant is the downtrend in the dollar. And there's a lot of work for the bulls to reverse this chart. I mean, even a rally on the Dixie back to 102 could easily simply be a fib retracement, sending it right back down to retest its lows. Particularly, it's hard to find a cross currency that is in a position to have the US dollar break out against it. The euro's bouncing along major resistance, but that is no different than the dollar bouncing along its lows. The yen has made a meaningful turn, and the pound sterling continues to just rip. And so with the way that the current backdrop is on the cross currencies, a bounce is probably all that the dollar is going to give on the short term. Maybe that will all change as we get past the FOMC meeting in September. But on the short term, I think it's going to be far more of a trade range bound into that next month.
Now, moving on to page 7, we have that gold futures chart. Eric, what are your thoughts here?
I put my gold chart in the deck this week. As you can see, we touched channel resistance last week, and we've been holding right under that R3 resistance line at 25.54 ever since. We're in a raging bull market, and the primary trend is definitely up. But markets never move in straight lines. The slow stochastics are high and wavering, and there's plenty of room for gold to trade $100 lower without invalidating the primary uptrend. If that happens, it's a swing buy for sure. But right now, we're just below those key resistance levels, so it's hard to justify adding to longs here until we give this market some time to consolidate or trade lower for another buy-the-dip opportunity.
Well, Eric, for me, I'm keeping this very simple. Gold remains in a bull trend, higher highs, higher lows, above all of its moving averages. Old dips keep getting bought, and there's upside measured moves that are still measuring all the way up to 2,700 on the upside. With the fact that the dollar has no imminent catalyst for a big reversal, there's every opportunity for this bull trend to continue. And until there's some sort of topping formation or some major news event that changes the trend, I think that you have to respect that the dominant trend is bullishly to the upside and likely to continue.
And moving on to page 8, we have that uranium chart. Eric, what are your thoughts here?
Let's start with the big news from last Friday morning. Kazatomprom, the big state-owned producer in Kazakhstan, issued guidance for 2025 production to fall 5,250 metric tons lower than prior guidance. That's fully 7.5% of global annual production that just got taken out of supply. And that's the reason for the gap up on Friday last week in uranium mining shares. But while the uranium miners gapped up, the metal itself barely moved at all. So the mining shares predictably retraced, closing that gap in many cases. So even a 7.5% reduction in global supply doesn't seem to have much effect on the physical uranium market, despite the fact that the mining shares reacted instantaneously, or at least it hasn't had much effect yet. Because I'll be traveling to the World Nuclear Association conference, I pre-recorded next week's feature interview today with Sachem Cove Partners CIO and fund manager Mike Alkin, one of the most respected experts on the nuclear fuel cycle in the investment community. Mike is even more bullish than I am long-term, and I think you're really going to enjoy next week's feature interview, which will air on the first full day of the WNA conference next Thursday. So be sure not to miss next week's MacroVoices for much more depth on the uranium market and specifically why Mike thinks the fuel buyers are not reacting to the news flow the way most investors would have expected them to. That's coming up on next week's MacroVoices.
Yeah, Eric, that supply chain news did impact the market, but it's interesting that the spot prices of uranium have not really reflected this yet. Certainly some short-term enthusiasm turning up many uranium stocks and the Sprott Physical Uranium Trust. But what will be really interesting to see is in the coming weeks whether or not the bulls follow through, particularly just a simple thing of just breaking the descending trend line and getting above a 50-day moving average would be positive signs that potentially potentially a new accumulation cycle might be beginning. It's very early, and it'll be very interesting to see whether the bulls can follow through. If it does, after a 6 or 7 month correction, you have to believe that a breakout on the upside here could really set in motion a new bull trend. It's certainly one of the kind of chart setups that is worth watching closely here in the coming week. Finally, on page 9, I had the 10-year Treasury yields, and I wanted to just highlight that we've been pinned into that 380 area that's been the year low, and at this stage, it's now going to likely stay in this area right into that jobs number, waiting to see whether or not there's a clue coming as to whether or not the Fed will move 25 or 50 basis points in the September FOMC meeting. And so that's going to be the key to watch. If for whatever reason they appear more dovish and indicating that the conditions in the market are softening, there's every opportunity for yields to even potentially break down towards its 2023 lows near 350, and that will be the thing to watch technically as to whether this 380 support line holds in that post-news period.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.